Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if companies are actually as shiny as their press releases make them seem. And today we're diving into some financing news from Vornado Realty Trust and its operating partner, Vornado Realty LP. It turns out even big real estate players need to keep their money lines flowing smoothly. And they just did a bit of housekeeping to make sure that happens for a good long while. So what exactly did Vornado do on January 7th, 2026? Well, they basically extended and tweaked some of their borrowing agreements. Think of it like getting a new lease on life for their company's piggy bank. They've got their main operating partnership, Vornado Realty LP, or VRLP for short, and they've been busy with their credit facilities. These are essentially big loans that allow them to borrow money when they need it, like a superpowered credit card for businesses. First up, they extended and amended one of their revolving credit facilities. Now, this particular loan was set to mature, meaning it was due to be paid back in December of 2027, even with the extensions. But they've pushed that date way out to February of 2031. That is an extra 3 years of breathing room. But here is a bit of a kicker. The total amount they can borrow under this facility, which is called the 2031 Revolving Credit Facility, has actually been reduced. It has gone down from $1.25 billion to $1.105 billion. So, less money available, but a longer time to use it. The cost of borrowing is currently termed SOFR, which is a benchmark interest rate plus 1.05%, and they also pay a facility fee, which is 0.25%. What is interesting is that these rates can go up or down by a little bit based on how green or sustainable their operations are. So the better they do environmentally, the slightly cheaper the loan might get. Then they tackled their term loan. This is another big loan, and they've also extended its maturity from December 2027 to February 2031. So again, that same long-term extension, but this time they've actually increased the loan amount. It is going up from $800 million to $850 million. So more money and more time to pay it back. The interest rate here is term SOFR plus 1.20%, and just like the revolving credit facility, this interest rate can also be adjusted slightly based on their sustainability performance. This shows a trend companies are increasingly linking their financing costs to environmental and social goals. On top of all that, they also made changes to another unsecured revolving credit facility. This one matures in April 2029. They've increased the amount they can borrow under this one too, from $915 million to a cool $1 billion. The interest rate on this one is termed SOFR plus 1.16%. So across the board, they're securing more long term financing, even if some of the available amounts are being slightly trimmed. It looks like they're strategically managing their debt to give themselves more flexibility and longer horizons. Now, who are the big players helping them make these deals happen? The filing lists a whole host of banks. We've got JP Morgan Chase Bank, Bank of America Securities, BMO Capital Markets, PNC Capital Markets, US Bank, National Association, and Wells Fargo Securities. These are your lead arrangers and book runners. Essentially the main banks putting this financing together. JP Morgan Chase Bank is acting as the administrative agent, which means they handle the day-to-day operations of these loans. It is a pretty extensive list of financial institutions involved, which often indicates the size and importance of these credit facilities. Alright, let's talk about the ground rules. These loans come with certain conditions or covenants that Vornado has to follow. One of the key ones is about how much debt they can have relative to their assets. Total outstanding indebtedness can't go over 60% of their capitalization value. This capitalization value is calculated based on capitalizing the income from their properties using different rates for different types of real estate. For office buildings, it is 6.5%, and for other properties, it is a range from 5.75% to 8%. This basically means they can't be too leveraged or too heavily in debt. They also have to maintain certain ratios related to their earnings. For example, their combined EBITDA must be at least 1.4 times their fixed charges. EBITDA, or earnings before interest, taxes, depreciation, and amortization, is a common measure of a company's operational profitability. Fixed charges are basically their interest payments and other obligations. So they need to be earning a good chunk more than they're spending on interest. Another important ratio is for their unencumbered combined EBITDA compared to unsecured interest expense, which needs to be at least 1.75 to 1.00. This specifically looks at their debt that isn't secured by specific properties, basically. They need to show they can comfortably cover their interest payments on this unsecured debt with their earnings from unencumbered assets. There is also a limit on unsecured indebtedness, which can't exceed 60% of the capitalization value of unencumbered assets. And finally, secured indebtedness can't be more than 50% of their overall capitalization value. These covenants are designed to protect the lenders by ensuring Vornado maintains a healthy financial position and doesn't take on too much risk. Of course, like any loan agreement, these come with standard evidence of default. These are things that, if they happen and aren't fixed, can allow the lenders to demand immediate repayment of the entire loan. This is pretty standard stuff for big corporate loans and includes things like failing to pay on time, violating covenants, or if the company goes bankrupt. So what does this all mean for Vornado? Essentially, they've locked in their borrowing capacity for the next several years, extending maturities well into the future. This is a smart move in the current economic climate, providing stability and predictability for their financing. Reducing the amount available on one facility while increasing it on another, and raising the term loan amount too, suggests a strategic shift in how they're planning to fund their operations and growth. The focus on sustainability kicking in with potential interest rate adjustments is also a strong signal about their commitment to ESG factors, which is becoming increasingly important for investors and the market. While the reduction in the 2031 revolving credit facility might seem like a negative, it's important to remember they also increased the 2029 facility and the term loan. This indicates they are actively managing their debt structure to align with their future needs and risk appetite. The strict covenants, while standard, highlight the importance of consistent financial performance for Vornado. They need to keep their debt levels in check and their earnings strong to avoid any issues with their lenders. Overall, Vornado appears to be taking a proactive approach to its financial management, ensuring it has the necessary capital and flexibility to navigate the real estate market. This filing isn't exactly a bombshell, but it is a crucial piece of operational news that underpins their ability to continue doing business. Alright, that is our breakdown of Vornado's financing updates. What is your take on these moves and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.